Hi guys, I'm Devang Mehra from the Financial Analyst, and today we'll be discussing the Doji Candlestick Pattern. I welcome you back to the episode 7 of the series of Candlestick Pattern Training. Doji is a very common occurrence in the stock market charts, and investors are more often than not always confused on how to act on this pattern. It is a one candlestick pattern and has left everyone in confusion. Today we'll be discussing what is the Doji candlestick pattern, what are the different types of Doji candlestick patterns, and how we can plot them in different time frames in the charts to basically trade profitably from these patterns. But before we get started, make sure you follow us on Instagram at the Financial Analyst, and also do not forget to join our WhatsApp group TFA Daily to be updated with the live stock market updates. So let us get started. So doji is basically a neutral pattern that is occurring in a lot of important patterns. So if you remember the morning and the evening star candlestick patterns that we have discussed earlier in the series, doji is the second day pattern. So in a doji, what happens is virtually the prices are opening and closing at the same level. What I mean by that is that the stock prices open at a particular level, and by the end of the day they are also closing at almost the same level, so giving a very small real body. So as you can see in all these cases, the real body will be very small, but at the same time the shadows or the high low range of the stock in a particular day will be very large. This is founded on the premise of indecision. So, on the day of Doji, there will be very high indecision in the market, therefore, giving rise to reversals in prices in the following time frames or days. In Japanese, Doji means blunder or a mistake, basically telling us about the rarity of having the open and close price almost the same, because generally we always see that we have a very big substantial real body, but in the case of a doji, the substantial part of the real body is missing. So let us discuss the different types of doji candlesticks. Depending upon the high-low range of the stock prices, we can have different doji candlestick patterns. The basic element of having a very small real body will remain the same. So number one, we have the doji star, which has the shadows relatively small. The second example, we have a long-legged doji, which has the high-low range or the shadows very large. So this tells us that the stock prices opened at this level. It went all the way down because sellers dominated, but by the end of the trade, the stock prices were pushed up by the bulls, wiping out the losses that were made in the opening session. But it again went down to the opening price and closing at almost the same level, thus indicating indecision in the market. So, if we look at it this way, this is actually a equilibrium price. What I mean by that is demand is equal to the supply at this level. So it is telling us that the buyers and the sellers are now virtually agreeing to settle at this price in the market. This is not the case in the other candlesticks, for example, the bullish candles or the or the bearish candles, where either the buyers are dominating or the sellers are dominating. Next, we have the dragonfly doji because it resembles a dragonfly. In the dragonfly doji, we will not have any upper shadow, but we will have a very small real body and we will have a very large lower shadow. The characteristics remain the same. That is, it will always predict a reversal in the market. We have next a gravestone doji, which is the opposite of a dragonfly doji. In a gravestone doji, we have a very large upper shadow, which tells us that the bulls were in control during the day, but during the ending session, the sellers pushed down the profits and the stock closed at the opening session. And lastly, we have a four price doji having a very small, even smaller than the doji star, the shadows. So now I want to go into the charts to show you the practical applicability of how we can spot these patterns. First, I want to discuss this on the Dow Jones Industrial Average chart in the New York Stock Exchange. So I will be using the stochastic indicator. If you do not know what it is, I will be discussing it in the later videos on our channel. So make sure you subscribe to our channel so you are updated with any new videos. So Doji, as we've already done, is a reversal pattern. So we had a very good strength in the downtrend. We had a very big, large red candle showing us that the sellers were in control. But the following day, we saw a Doji candlestick, which tells us that there was huge indecision. This is nothing but, if you remember, it is a long-legged doji that is telling us that the price is open at a particular level, at this level. Then the sellers were in control, pushing the prices down. And in the afternoon session, the bulls pushed up the profits. But at the end of the day, it closed back at the level on which it opened. So it tells us the indecision in the market and that the reversal is bound to happen. And that is why we saw a very good rise in the prices in the later days. And this doji was complemented by the stochastic pattern in which we saw that the prices were oversold and we had a very good positive crossover showing us a rise in the prices. So always make sure you are using the doji with other candles, other indicators and oscillators. For example, stochastic or RSI, or you can use it with a directional movement, average directional index. Next up, we have a gravestone doji. If you look over here, we had a very good uptrend, and at the end of the uptrend, we saw gravestone doji showing us that the bulls were in control, but at the end, the sellers pushed down the prices, and now we also had a stochastic overbought signal showing us that the prices were going to fall, and the prices started making new lows. I want to discuss this on the Indian charts now. This is the charts of Nifty. If you look at this price level, we saw a small downtrend and we saw a doji. This was actually a part of a morning star pattern and the prices started to make new highs. This was also a long-legged doji and complemented by the stochastic pattern, showing us indecision on this day and equilibrium price of demand and supply. Next up, we had an evening star pattern which has a second day as a doji. This was also a long-legged doji and complemented by the stochastic signal, showing us indecision and reversal bound to happen. So it is, if you can complement it and use it in conjunction with other indicators, we can see that we can enter trade profitably. For example, we could have bought the share over here and sold the share over here. We got a good amount of profit. Just a couple more examples to clear the concept for you. We saw a dragonfly doji at this price level. It shows, and it is also complemented by stochastic. We saw prices were making highs, and after this level, prices fell. So this was acting as a very important reversal pattern. Here is another example of a long-legged doji. Prices made some minor uptrend, and after the long-legged doji, there was signals of indecision and reversal in the market, and prices fell down. So as you can see, dojis are a very important candlestick, and whenever we see a doji in the market, we need to become alert as to that if it is followed by a bullish or a bearish pattern, we can see a reversal in the market. Also, I want to discuss that we should not always use these candles by themselves. What I mean by that is, for example, over here we saw a good uptrend and we saw a doji being formed over here. Any trader, if used doji itself, would have predicted a fall in the prices because we had a good uptrend. However, prices after the doji started to make a very high level. So whenever we are using the doji, we should always use it in conjunction with other indicators and oscillators to basically negate the effect of any false signals. because Doji can also be used, for example, in this situation as a continuation pattern. So in this case, if we can use the ADX or the directional movement, we would have seen that there was a very good strength in the uptrend. That is why one Doji cannot just negate the effect of a very strong uptrend. So try to spot dojis on the charts and try to trade profitably from them, because it will be acting as a very strong reversal point. But at the same time, as discussed, make sure you see what is the strength of the trend. And because dojis can, just one candlestick of doji cannot negate the entire uptrend or the downtrend if it is very strong. So I hope you enjoyed this video. If you have any questions, make sure you message us on our email or WhatsApp. Our links are in the bio. I hope you had a nice day, and we'll see you next time.
Hey, hey, hey! Why stop now? View our other videos to learn more. But before that, don't forget to join our WhatsApp group. Please do like and share our videos, and also subscribe to our channel. Hit the bell button to never miss an update.